Good morning and welcome to today's webcast, Revenue Recognition for Healthcare, Implementing the New Standard. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Kimberly Sokoloff, Senior Manager, and Brian Connor, Partner. Brian, I'll turn it over to you to get us started.
Great, thanks, Emily. Appreciate the introduction and welcome to all those on the line. So, now that we have, now that Topic 606 is here and it's applicable for this December 31st year-end 2018 for public reporters at least, we have more information, from continuing interim disclosures, public registrant filings, completed work from interpretive groups, like the expert panel and AICPA RevRec task force, to hopefully provide us with a little bit less abstract discussion on this particular standard, the RevRec standard. So our objectives today are really, to try and describe the unique aspects of adopting the new revenue recognition standard as they apply to healthcare entities and to identify practical and operational considerations of implementing the new standard. We assume there are also those in the audience who, might be thinking, well, I guess it's time that I kind of open this up and read it for the first time. So if you're out there, you don't have to raise your hand, but we will review some of the fundamentals of the standard. But, given that we only have an hour, we're necessarily flying at a pretty high level, and we kind of want to focus on the practical and the operational. I do have one note I want to make, and that's I did notice on the attendee list a little while ago that we do have some GASB reporters out there, I think. So this is, just to clarify, this is for FASB ASC Topic 606, the new FASB Revenue Recognition Standard. So obviously this isn't going to apply to GASB reporters. However, GASB is currently contemplating a performance obligation model in their revenue and expense rec project that they've got going on. So don't hang up yet. I think there's a lot of information that will be very relevant to what GASB does. So those are our objectives for today. And Emily, I think we already have a polling question here. I'll turn it back to you. You're going to have to put your thinking caps on for this one.
All right, thank you. Our first polling question, what type of organization do you represent? And your options are a hospital or health system, senior living organization or long-term care provider, other healthcare provider, healthcare payer, or other. And I'll give everyone a few moments to make a selection here. To participate in our polling questions today, please click the button next to the answer you choose and make sure to hit submit. I'll give everyone a few more seconds. And let's take a look at the results. Brian, back to you.
Great, thanks, Emily. So we've got a pretty broad spectrum here of providers in the space, so that's good. Let's start with the scope of this standard. It includes all contracts with customers except for those that fall under the lease contract guidance, the insurance contract guidance, financial instruments, guarantees, and non-monetary exchanges. And then, of course, contributions and collaborative arrangements are excluded. So when we talk about insurance contracts, that means insurance contracts accounted for under Topic 944. So for those that clicked payer in the previous slide, if you're accounting for your plan or insurance company under Topic 954, the healthcare standards, the 605, 606 is going to apply to you. And then for contributions, you kind of work through that new contribution exchange versus non-exchange model. If you have an exchange transaction, it's in 606. And if you end up having a contribution, you're not in 606. So that guidance would be important for kind of figuring out whether you're in 606. That's 2018-08 ASU. So the effective date and transition here for public entities, fiscal years beginning now, essentially, December 31st, 2018, and of course including the interim periods within those years for that's public registrants, public business entities, as well as not-for-profit entities that are conduit debt obligors. So there are probably folks in the audience that have been applying this on an interim basis and are working to do this on their year-end financial statements. And then for non-public entities, you've got a year. And the interim period disclosures would apply in the following year of application or implementation. So for transition approaches, we've got full retrospective. You restate the prior years, and you may use one or more of the practical expedients. This practical expedients really are primarily related to what you do with contracts that kind of extend from the old method into the new method. And then we've got the modified retrospective approach, which is to record a cumulative effect adjustment in the beginning of the current year of implementation. So I think, from a transition approach perspective, fully retrospective might be a little bit cleaner from a presentation standpoint. You'll have financial statement line items will be the same in each individual year, but your decision on how to do this might be most dependent on disclosures. So fully retro is going to include the new disclosures for the prior year, but modified retro also includes kind of a disclosure reconciliation from line items from the old to the new. And from a cumulative effect adjustment perspective, I think, and we might talk about this later, it's likely for healthcare organizations that you're not looking at a big, a cumulative effect equity adjustment, something where implementing this is changing significantly the timing and the amount of revenue recognized. But those are the effective date and transition approaches. And Emily, we've got our second polling question.
All right, our second polling question today. How far along is your organization with your Topic 606 implementation efforts? And your options are fully implemented, in progress, early stages, or not started, or I'm not sure, or this is not applicable. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Our final polling question today is near the end of the presentation, and we'll do our best to get to that before we begin the Q&A portion of the webcast. A few more seconds, and let's take a look at the results. Back to you.
Good. And Kimberly, I think I'll turn it over to you here.
Sure. It looks like a good majority are still thinking through the revenue standard and are in the early stages. So I am glad that you're on the webcast today. Hopefully we can keep things moving for your implementation efforts. And then this slide lists the new revenue standard. It is a principle-based standard. The revenue is guided by a core principle, and that is that we will recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Now that's a mouthful and it's very high level. There are 5 steps in the standard that provide guidance as to how to apply the core principle. The first step is that you will identify the contract with the customer. The second step is that you identify the performance obligations in the contract, so what you promise to do in exchange for the consideration. The third step is you determine the transaction price, the money that you'll receive in exchange for performing the services. And then step 4 is if there are multiple elements to the arrangement, you would allocate the transaction price to the various performance obligations. And lastly, and very importantly, step 5 is you will recognize revenue when or as the performance obligation is satisfied. So when you have done what you have committed to do. So the 5 steps are helpful, certainly, but I'm sure you can appreciate under current GAAP for healthcare entities, there are more prescriptive guidance in various sources, such as AICPA guidance. So it could be a little bit disconcerting to think about how to apply this more higher level principle-based guidance to specific facts and circumstances. Fortunately, the AICPA has gathered a group of individuals on a healthcare entity revenue recognition task force comprised of individuals from industry, CPA practitioners, and other interested parties, and they have taken it upon themselves to identify unique issues with implementing this new standard for healthcare entities. And they've been working on these issues for quite some time. We appreciate their efforts. What you see on the slide is a listing of the specific issues that this group has tackled. All of these issues are now finalized and they are incorporated into the AICPA Revenue Recognition Audit and Accounting Guide in Chapter 7, which relates to healthcare entities. And several of these items were recently finalized in 2018. So if you have listened to or participated in revenue recognition webcasts or conferences in the past, you might not have heard about some of these recent issues. So we will touch on a few highlights of these. Certainly, as Brian mentioned, we won't have time to go into every single detail, but we will give you a flavor of the important aspects of each of these issues. The revenue standard is a contract-based standard, so step 1 in determining if you are able to recognize revenue is to determine whether you have a contract. A contract is an agreement between 2 or more parties that creates enforceable rights and obligations, and enforceability is a matter of law. There are several items that need to be in place in order for a contract to exist. Collection of substantially all consideration is probable. The rights of parties and payment terms can be identified. The agreement has commercial substance, and it has approval and commitment of the parties as to their obligations. I'll touch on collectability and contract approvals in more detail on the next slide. Regarding the rights of parties and payment terms, in a provider setting, sometimes the specific payers and the payment amount may be unknown at the time services are provided. For example, a patient may be admitted to a hospital emergency room and be unresponsive. The hospital is obligated to provide services to the patient as required by law. If the hospital subsequently determines that the patient is uninsured, it may try to qualify the patient for Medicaid coverage. This qualification process could take several weeks to over a year, so a hospital may classify this patient initially as Medicaid pending. Because the hospital doesn't know the final payor and payment amount, does that mean that there isn't a contract until Medicaid issues their final decision? Well, if a hospital has historical information on the ultimate payer class for similar Medicaid pending individuals, for example, which percentage of those contracts historically end up qualifying for Medicaid, which percentage historically qualifies for charity care or becomes uninsured self-pay, and if it has historical collections experience for each of these payer classes, the contract will fall within the scope of the standard, and the hospital would use their historical experience to determine the payment terms and estimated consideration amount to recognize as revenue. If the hospital doesn't have historic information on the ultimate payer class, the contract likely does not fall within the standard until that information becomes known. As we just mentioned, one requirement is that the parties have approved the contract. This could be in writing, orally, or implied in accordance with other customary business practices. A written contract with the patient could be the signed conditions of admission form, and for a CCRC organization could be the signed resident agreement. If the healthcare entity determines it does not have a written contract, for example, the patient is unable to sign a patient responsibility form, it may consider whether it has an oral or implied contract. If the patient calls and schedules healthcare services in advance, for example, an elective procedure, the healthcare entity may determine that it has an oral contract. If the patient does not schedule the services in advance, for example, our patient that was admitted through the emergency room while unconscious, the healthcare entity may look at customary business practices. They may be obligated to provide services to the patient as required by law, and as such, they may have a contract that's implied based upon customary business practices. Now, with collectability, the standard also states that in order for an entity to have a contract and recognize revenue, collection needs to be probable. There was some initial excitement when the standard first came out about uninsured self-pay balances, where collection is generally a small percentage of full billed charges. Some thought perhaps this revenue stream would need to be accounted for on a cash basis, since full billed charges are not probable of collection, and they won't know how much they will collect until the cash comes in. Fortunately, that will likely not be the case. When evaluating collectability under Step 1 of the standard, entities need to consider the probability of collection of substantially all of the amount to which they expect to be entitled to. The amount they expect to be entitled to could be different than the billed or the discounted contractual charges. For example, a healthcare entity may know that based upon their historical experience, they don't expect to collect full billed charges from certain patient classes, such as uninsured patients. They may determine that the amount they expect to be entitled to is significantly less than the billed amount, and they may determine that lower amount really is probable of collection based upon their historical collection experience with that patient or a similar grouping of patients, and therefore the collectability criteria is met. For CCRC organizations, collectability may be assessed up front for certain revenue streams during the new resident screening process, so that would generally satisfy this element of the contract criteria. Step 3 of the standard is to identify your transaction price, and your transaction price is the amount of consideration in a contract to which an entity expects to be entitled in exchange for transferring what they promise to do, their promised goods or services. The transaction price can be a fixed amount, but it may also include variable consideration. The transaction price is also adjusted for the effects of the time value of money if the contract includes a significant financing component, and is also adjusted for any consideration payable to the customer, which would generally reduce the transaction price. If the consideration is variable, meaning the ultimate consideration depends upon a future event occurring, an entity estimates the amount of consideration to which it will be entitled, and that estimated amount of variable consideration will be included in the transaction price only to the extent that it is probable that a significant reversal of that amount will not occur when the uncertainty associated with the variable consideration is subsequently resolved. That is known as the constraint on variable consideration, and we'll expand on that in the next slide. There are various types of variable consideration to incorporate into the transaction price, and I'll touch on two of the important points here on this slide. Medicare and Medicaid cost report settlements and other government payer arrangements, these often involve best estimates to be made during the current year, which are then trued up in subsequent years when, let's say, the cost report is filed and ultimately when Medicare or Medicaid complete their audits. That won't change under the new standard. However, keep in mind that constraint on variable consideration. If you know, based upon historical experience, that you typically experience revenue reductions when you file your cost report in the following year and or when the related audits are completed, then you may need to reduce your initial estimate of revenue to be recognized in the current year because the constraint says you can only recognize variable consideration revenue if it is not probable that a significant reversal of revenue will occur in future years. Now, currently, a lot of providers will try to capture this revenue reduction potential through the use of reserves. So net revenue recognition for this may not change too much under the new standard, but it's something to keep in mind. And then secondly, implicit price concessions are where customary business practices indicate that an entity will accept an amount less than established charges and either provide services prior to performing a credit assessment or continues to provide services even when they know they will likely not collect all of the established charges. So again, think about that uninsured patient example. Historical experience shows entities will likely not collect full billed charges, so instead of recording revenue at the billed charges and then recording a bad debt allowance either up front or down the road, entities will now estimate upfront the amount they do not expect to collect based upon their historical experience, and that's known as the implicit price concession, and that net revenue or that lower revenue amount is what will be recognized upfront. And that includes consideration of the implicit price concession as a reduction to the revenue that is recognized upfront. So because of this implicit price concession concept, many healthcare providers believe their provision for bad debts, especially related to self-pay balances, will be significantly reduced compared to current GAAP. So when would you have bad debt expense? If a healthcare entity performs a credit assessment prior to providing services to a patient and expects to collect all of the discounted or billed charges, for example, maybe a CCRC organization where a financial screening process may be performed prior to accepting a new resident, so you feel pretty good about the resident's ability to pay the subsequent charges. If something happens down the road and the patient isn't able to pay, that may constitute bad debt expense. So really just want to highlight a couple points. I think it's really important, and this will be impactful for many healthcare entities. If the customary business practice is to not perform a credit assessment prior to providing services, or you continue to provide services to a patient or a patient class even when historical experience indicates that it's not probable that you'll collect all of your discounted charges, your billed charges, then you have provided an implicit price concession to the patient, even if you'll consider or continue to attempt to collect the full amount of the discounted or the billed charges. Therefore, you would adjust your revenue amount for the implicit price concession, which is the amount historical experience shows you're not going to collect, rather than having that amount flow through as bad debt expense. And this is a change in the way of thinking compared to current GAAP, and it's subjective, and it will take a significant amount of judgment to be applied to your specific facts and circumstances, so I wanted to highlight that. And then a few operational considerations. We'll need to create a new definition of bad debt expense under the new standard, which will not be purely driven off aging categories as may be current practice. Based upon this new definition of bad debt expense, we'll want to identify how organizations will track amounts that meet this new definition. They haven't needed to separately track amounts under this new definition before. And then before you throw away the old definition of tracking of bad debt expense, consider if there is still a need to track amounts under the old definition of bad debt expense, maybe for Medicare or Medicaid cost reporting purposes. And finally, when you make your initial estimate of your implicit price concession and you record your net revenue, subsequent to that point, if your collections come in either higher or lower than that initial estimate, that would be a change in estimate that would be flowing through revenue as opposed to recording to an expense. And a final reminder, variable considerations such as these implicit price concessions, these need to be reassessed at each reporting period. So Brian, I'll turn it over to you to talk through the portfolio approach.
Great, thanks, Kimberly. Yeah, it seems like in healthcare we change how we account for bad debt every 5 to 10 years, so perfect timing on topic 606. And as it says here, and as Kimberly mentioned earlier, the patient is the customer in this approach most often. And the standard, of course, is generally applied on a contract-by-contract basis with the customer. So if you think about that in a healthcare perspective, applying this on a contract-by-contract basis to each individual patient sounds like that would be awfully hard to do. So fortunately, FASB has provided a practical, expedient portfolio approach. So healthcare entities may use a portfolio approach as that practical expedient whereby the revenue guidance is applied to a portfolio of contracts with similar characteristics. And the important point here is the portfolio approach is allowed if the entity reasonably expects that the financial statement effects of applying the standard to the portfolio would not be materially different than applying it to each individual contract within that portfolio. So essentially, the sum of the individual parts needs to be pretty darn close to the whole for that to work. But we do have the ability to apply portfolios in implementing this standard. So when you consider the concept of applying the portfolio approach to contracts with patients, there are a few considerations in here to think about in terms of how you group contracts and what are the similar characteristics within the portfolios that would provide for those contracts to be included in the same portfolio. You could use type of service, whether it's inpatient, outpatient, skilled nursing, home health, et cetera, types of payers, dates when contracts are entered into, before and after a price increase, for example, or it may be a combination of a number of these factors. For example, you might have uninsured self-pay, insured patients with a copay, insured patients with deductibles, et cetera. Those are some of the factors that you consider when you're considering which contracts to group into portfolios to apply the revenue recognition standards. Using a portfolio of similar transactions to make certain estimates and judgments is not necessarily the same as applying the portfolio approach practical expedient, however. In other words, if you're using a historical collection percentage to assess certain things, for example, as Kimberly mentioned before, you're using a historical collection percentage to assess collectability in step one for a single contract, that's not necessarily using the portfolio approach. However, the concept of historical collection percentages will likely be closely correlated with portfolios that you establish. If you believe that you have a class of patients that is homogeneous enough to establish a meaningful collection percentage, you definitely want to consider using the practical expedient of accounting for those contracts under the portfolio basis as opposed to individually, which I think kind of leads to the next question, which is, are my payer classes that I currently have effectively my portfolio? And the answer to that, of course, is maybe. When you think about implementation considerations, you may need more disaggregation for the portfolio approach than you have with your current reserve model. And really, the primary item, as we mentioned before there, is you need to support the assertion that the portfolio approach does not yield a materially different answer than a contract-by-contract approach. So the question is, if I have a current payer financial class that's a Medicaid financial class, is that appropriately disaggregated to assure that I'm going to get the materially consistent accounting result that I would with individual contracts, or is my portfolio more appropriately something like Medicaid, managed care, inpatient, something at a little bit more granular level to meet that standard in the new topic. So let's talk about how this applies to third-party settlement estimates. Examples, of course, are cost report settlements, RAC accruals, might have certain other supplemental payment programs in there like DISH, for example. You have those components of your contract are really variable consideration. And you measure your variable consideration for those using one of two approaches, the expected value method or the most likely amount method. Expected value would be kind of a sum of probability weighted amounts. You might say, here are the 4 potential outcomes, and here's the percentage probability of each outcome. You weight those out, and that would be the amount that you record. Or you have the most likely amount, the single most likely amount in a range of possibilities. That's really the current practice with third-party settlement estimates for revenue recognized under 605. And although the definition in the standard says this would most often be utilized when you have basically a binary outcome option, you have 2 possible outcomes, FINREC believes that this method could be appropriately applied to third-party settlement estimates if that's determined to be the method that results in the most accurate result. So you likely will be able to use the most likely amount method, and you wouldn't have much difference between what you're doing now under 605 and what you would do going forward under 606. The item that we don't mention here is, in a bullet point at least, is the concept of significant financing component. I think Kimberly talked about that a little bit earlier. When you think about the timing involved for third-party settlement estimates, I think it naturally brings up the question, do I have a significant financing component related to that variable consideration? And FINREC believes that a significant financing component likely does not exist for third-party settlements because the timing of the payment is at the discretion of the third-party payer and does not involve the patient, that is, the customer. So likely you don't have to incorporate the concept of significant financing component. when you're looking at these kinds of things that may take a period of time to settle out. So risk-sharing arrangements. The AICPA Revenue Recognition Guide, Chapter 7, talks about risk-sharing arrangements kind of in the context of an example from the comprehensive joint replacement model under Medicare. The risk-sharing elements, you're really dealing with variable considerations. So a lot of considerations might be consistent with what we just talked about on the previous slide. Probably the most important bullet point here is constraint on revenue. Kimberly talked earlier about what a constraint on variable consideration is and the definition there. And the question in risk-sharing arrangements is, do we have sufficient historical or current information to estimate appropriately the outcome of those sharing arrangements and the ability to record variable consideration that is not constrained, that won't be probable of significant reversal in the future. And that's usually the issue with those. I imagine that the issues that you're currently dealing with relative to risk-sharing arrangements would be similar to those that you would deal with under Topic 606. Constraint on revenue. Do I have sufficient information to be able to estimate and record revenue at any particular time as I approach a period end? So performance obligations. Kimberly talked about this in the model. Performance obligations is an important part of the five-step process. It's a promise in a contract to transfer a good or service. It's your obligation as the service provider to perform in a contract where you will receive consideration in return. So the criteria, this is kind of the standard language for the criteria to have a performance obligation. You must have a distinct good or service or a series of substantially similar distinct goods or services that have the same pattern of transfer. And to be distinct, you must meet both of the following bullet points. The customer can benefit from the good or service, and the promise to transfer the good or service is separately identifiable from other promises in the contract. And promises are not separately identifiable if the goods or services significantly modify or customize another good or service in the contract, or the goods or services are highly interdependent or interrelated with each other. So in a healthcare environment, you take inpatient and outpatient services, for example. Generally, you're talking about a bundle of goods and services accounted for as a single performance obligation. So if you think about an inpatient stay, for example, there's going to be a number of services that are provided. In each lab test, supply, x-ray, pharmaceutical, room charge, etc., would not create a separate performance obligation. Those are bundled together. They're not distinct services. They're highly interdependent on each other for the ultimate service, which is the provision of care for a particular diagnosis. So you're likely looking at a bundle of goods and services that are accounted for as a single performance obligation, even if you have a payment contract that pays on, say, a percentage of charges, if those still exist. Regardless of how the consideration is paid in the contract, you're evaluating how you allocate that consideration over what performance obligations based on the standards of identifying performance obligations. And these will typically be satisfied over time as the patient simultaneously receives and consumes the benefits provided. So, I think it sounds pretty similar to how you would recognize revenue currently as you're accumulating charges within a particular stay. recognizing revenue over the duration of that episode as a single performance obligation. But the point is you're recognizing that as you satisfy those particular service obligations over time, as opposed to recognizing at a point in time at the end of the stay, for example. And then physical therapy is an example where it might be different if you have distinct service obligations, or the bundle of goods and services is delivered over a longer period of time. You would recognize that over that period of time, satisfied over each visit. One issue that I think comes up here from a performance obligation perspective is how you treat patients that are in-house at the end of the reporting period. There's a concept within Topic 606 that talks about contract assets and liabilities. And if you have performed under a contract, but you may not have an unconditional right to all of the consideration in the contract, you may have a contract asset versus a accounts receivable. Accounts receivable really derive from services that have been provided or performed where you have an unconditional right to the consideration. And so we'll talk about in a future slide, you may see that in-house AR, unbilled in-house AR, looks more like a contract asset than an accounts receivable at the end of the period. That's how it's being treated by certain public registrants. And that will be an optics issue more than a substantive issue, I believe. And then performance obligations for risk-sharing arrangements. We talked about the risk-sharing before. I don't think that's a lot different. For example, the CGR episode would be very similar to other kinds of inpatient service recognition. And one bullet point here that I think is important is the concept of care coordination activities and case management services. Generally, and according to FINREC, those types of services would not be in and of themselves distinct performance obligations and separate performance obligations. Those would be part and parcel to the service being provided. It's possible that in a bundled kind of arrangement, bundled service arrangement or risk-sharing arrangement, if you have other points of care, post-acute, for example, that may constitute a separate performance obligation that you'd want to take into consideration as you're allocating the consideration in the contract and recording revenue. But generally speaking, I would think that the performance obligation aspect, risk-sharing arrangements would be very similar to other kinds of inpatient stays. And then, Kimberly, I'll turn it back to you maybe to talk about performance obligation from a post-acute senior living perspective.
Sure. Similar to inpatient services that Brian just discussed, a skilled nursing patient may be receiving individual goods and services such as room, meals, pharmaceuticals, etc. However, the nature of the skilled nursing facility's promise to the patient really is to transfer a combined item, skilled nursing services. So these would generally be accounted for as a single performance obligation. Now, a patient may enter into, let's say, a 30-day contract with the SNF facility. However, if they have the right to terminate the contract after each day with no penalty, then each day of service really represents a single performance obligation satisfied over time. And the additional daily renewal options could be considered a material right under the standard, which would be an additional performance obligation. But generally that occurs only if the additional days are offered at discounted rates that another patient would not be able to obtain if they were not part of this contract. So just something to be aware of. And then for CCRC, the typical agreement for a Type A life care resident provides that the resident can live at the CCRC and access health care as needed for little or no increase in periodic fees other than as stated in the agreement. And the goods and services the resident will receive are dependent on the resident's health and lifespan, along with their decision to continue to reside at the organization. So the promised good or service, which is the performance obligation for a Type A life care resident, is that the CCRC is standing ready each month to provide a service such that the resident can continue to live in the CCRC and access the appropriate level of care based upon their needs. Other goods and services offered separately by the CCRC that aren't included in those monthly fees should also be assessed to determine if any additional performance obligations exist in that arrangement. A non-refundable entrance fee paid by the resident under the Type A life care contract contains a material right because, in effect, the resident is paying the CCRC in advance for future goods or services. And just like with the skilled nursing, CCRC should evaluate whether monthly renewal options included in the resident agreement provide a material right to the resident. So Emily, it looks like we have our third polling question, which is a bit more technical, but keep in mind you just have to submit an answer to obtain the CPE.
All right, our third question. Performance obligations for which service lines are generally satisfied over time versus at a point in time? And your options are inpatient healthcare services, outpatient healthcare services, skilled nursing facility services, or all of the above. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handouts to the right of the slide view. And we'll also be sending the slides via email after the webcast. Give everyone a few more seconds. And let's go ahead and take a look at the results. Kimberly, back to you.
Okay, great. Thanks, Emily. Well, everybody's right, all of the above. So each of these service lines, the performance obligation would be satisfied over a period of time because the patient is consuming the benefits, receiving the benefits as the entity performs the service. So that is something to keep in mind as you're drafting your new accounting policy disclosures. A few additional considerations for CCRC organizations. The first is to consider whether some or all of your revenue arrangements contain a lease, such as perhaps independent and assisted living housing revenue. If so, these revenue streams may fall under lease accounting instead of this revenue standard. If you do follow current lease accounting, just a reminder that the new lease standard, once it is adopted, may have different criteria. And the AICPA Healthcare Expert Panel will be providing guidance in the future on this concept, so if it is relevant to you, you'll want to monitor the developments on their webpage. Second, with the contract terms, the resident agreements may be for a specified term, perhaps for the life of the resident. However, if the resident is able to move out each month without financial penalty, for the purposes of applying this standard, you will have a monthly contract with an option to renew. And finally, regarding when and how to recognize revenue under the standard, for the monthly fees, you would recognize on a monthly basis when those services are performed. And as we just mentioned, the non-refundable entrance fee creates a material right associated with the ability to access future services. And there are two acceptable methods of amortizing the fee into revenue, which are shown on the next slide. The first is a time-based method, which is similar to current practice. The fee would be allocated in an equal amount each month over the expected life of the resident, since the nature of the performance obligation is to provide services when and as needed each month for this duration. The second is a matching concept, which would estimate when future costs would be incurred for the resident and look to match the timing of revenue with when these costs would be incurred, which generally would result in delayed revenue recognition in most cases. I have yet to see an organization choose option B, but it is available. And then refundable entrance fees, just like current practice, these are recorded as a liability and excluded from the transaction price since this represents consideration due back to the customer. The future service obligation, the accounting and calculation for this doesn't change from current practice. However, the revenue and expense inputs may change, particularly if the matching allocation method we just talked about is selected for the non-refundable entrance fee. And with cost of acquiring contracts, the rules have gotten a bit more stringent regarding what costs you can capitalize related to new contracts. Only incremental costs that are directly related to a specific new contract and would not have been incurred without signing the new contract would be capitalized. So essentially, sales commission expenses may qualify. And if your organization has an unamortized balance of previously capitalized marketing costs and those costs do not meet this revised definition, they may need to be written off upon adoption. And then for a significant financing component, the new revenue standard requires an adjustment to the transaction price, discounting for a significant financing component. The non-refundable entrance fee is what would be evaluated for CCRCs since it is money provided up front. Likely, organizations will conclude that the primary purpose of the resident providing the upfront entrance fee is not for financing purposes, but rather to provide residents with the security and the assurance that the CCRC organization will provide the requested services when the resident needs them. In that case, no significant financing component would be factored into the transaction price, but still an important consideration to evaluate. With the new standard, there are additional disclosures required. I will just touch very briefly on one for public entities, which includes not-for-profit organizations that are conduit bond obligors. There is disaggregated revenue requirements, and the standard gives some additional guidance to understand at what level you're expected to disaggregate your revenue. It recommends that you think about how you disaggregate revenue in information presented outside of the financial statements, for example, annual reports, investor presentations, and also that you look to the revenue disaggregation of perhaps your CEO or your board, how they view revenue in order to make their strategic decisions. And a few example categories are listed here on the screen. The next two slides show examples which come from the AICPA Revenue Recognition Guide for healthcare providers as possible ways to disaggregate revenue. And you might find that one level of disaggregation is appropriate or multiple categories of disaggregation is appropriate for your organization. For revenue disaggregation by payer, keep in mind that under the new standard, this would be under net revenue. And a lot of times organizations track gross revenue by payer, so you'll want to think about if the disaggregated net revenue information is available at your organization. And also think about at what level the revenue disaggregation by payer is most appropriate at. And then you can see on this slide, here's an example of revenue disaggregation by service line, method of reimbursement, timing of revenue recognition, as well as by geography. And lastly, we wanted to summarize just a few takeaways from SEC filers that have needed to adopt and disclose this starting in their interim periods of 2018. For CCRC organizations, it seems that everybody used the modified retrospective adoption approach. Allowance for doubtful accounts was either zeroed out in the current year or was significantly reduced. And bad debt expense was generally included in operating expenses since any remaining bad debt expense was deemed immaterial for separate disclosure. And Brookdale did disclose that they account for their housing service revenue for independent and assisted living under ASC 840, the currently standard, and they're still evaluating under the new lease standard. So Brian, any key takeaways from the hospital companies you'd like to highlight?
Yeah, great. Thanks, Kimberly. So in tenants and community health systems queues, they are using the modified retrospective adoption approach, so cumulative effect adjustment and presentation in the current year only. And so in that presentation, you can see the financial statements and the balance sheet. There's no longer a disclosure of allowance for doubtful accounts. That the portion of that would be now considered implicit price concession is included in the net accounts receivable number, and there's disclosure around that later in the financial statements, but you don't see that highlighted on the balance sheet. And of course, bad debt expense is now included in operating expenses. Under the new, whatever is in the new definition of bad debt expense rolls into operating expenses, and what was previously bad debt that is now implicit price concessions nets into net patient service revenue. And these two are using in-house the contract asset method for in-house patient accounts receivable that are unbilled. Those aren't accounts receivable, they're contract assets on the balance sheet. So if you're looking for some practical guidance on organizations that have already implemented, those are two that have public filings out there that you can check out. And with that, I'll turn it over to Emily for our final polling question. Make sure everybody gets their CPE.
All right, our last question. What transition approach has your organization selected or is likely to select? And your options are full retrospective, modified retrospective, or I'm not sure. And once you have completed all CPE requirements, you will be able to download a copy of your CPE certificate from the CPE progress widget to the right of the slide view. Give everyone just a few more seconds to make their final selection today. And let's go ahead and take a look at the results. Brian, back to you.
Great, thanks, Emily. I'm not surprised by the not sure. And as I mentioned in an earlier slide, there's a few things to think about there. So talk with your advisors and look at some other publicly available information to make your decision there. I think, Emily, we might have time for just a couple of questions. If you have any from our participants.
All right. Let's see here. If you do have any questions for our presenters, you can enter that in the Q&A box under the slide view. And we'll start with, how is the portfolio approach different from the current practice for estimating the patient accounts receivable contractual allowance?
Yeah, I can take that one, Emily. Some of the webcast participants have observed that the portfolio approach sure sounds familiar to what's done in current practice. I would say that likely under the new standard, organizations will find that they need more disaggregated categories in their contractual model to meet the definition of the new standard. And as a shameless plug, as an audit firm, I think it's always a good idea as you're assessing your level of disaggregation and portfolio approach to involve your audit team in the dialogue early on instead of waiting until the typical audit field work. That way they have the opportunity to weigh in and provide recommendations.
Great, thank you. And we can probably fit one more in here. Based upon this overview, is it expected that the bottom line for companies will change under the new revenue standard?
Yeah, and I think Brian briefly touched upon this, but certainly a change in how we approach our policies and procedures, and those will need to change. But when you hear this webcast, likely the bottom line will not significantly change under the new standard. You may have some revenue changes with the implicit price concession that will be baked into your very top line of revenue now. And if you do think that you have bad debt that meets the new definition, that will be down in expenses. But your net bottom line impact of the revenue standard for many healthcare organizations is not expected to significantly change.
Great, thank you. And I think that is just about all we had time for today for questions. If you had a question that we did not get to, we will do our best to follow up with you after the webcast. And thank you, Kimberly and Brian, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.